All right. Great to be here. It's been a fantastic conference so far. Notwithstanding the somewhat depressing topic, we have a lot of exciting things to share with you, and I think we'll kick things off with some introductions. We're going to start with Khing, who was inadvertently omitted at the outset. So.
Thanks, Melissa. Great to be here. I'm Khing. I'm a special advisor crypto to Attestor. We're an $8 billion London-based hedge fund focused on distressed assets, and we're a very active participant in the crypto distress space. Buying claims. I've been in distress for most of my career at Goldman, for a number of funds, and also a Web3 entrepreneur.
Hi all, I'm Asher, co-founder of US Bitcoin Corp. We're a large North American-based mining company. I'm actually an entrepreneur by trade and recently fell into the distress world in Q4 of last year. Have been involved in a couple of bankruptcies, whether it be as a bidder of assets, serving on the UCC committee, or most recently with the Celsius bankruptcy. We're a part of the Fahrenheit group and put that group together to acquire the Celsius assets out of bankruptcy and turn it into a new company.
Awesome. Michael, also more commonly known as wassielawyer. I absolutely am not a co-founder at Overy. I have a lot of questions to answer if that was the case. I'm a consultant at Overy. Previously, I was a lawyer specializing in restructuring and insolvency. Probably became quite well known because I started tweeting about how insolvency works in the crypto arena.
Great, thanks. And I'm Melissa Bender. I'm a partner at Ropes & Gray based in our San Francisco office. I'm in the asset management group, and I also lead our crypto and blockchain practice. So just to kick things off, I think maybe good just to do sort of a quick refresher, sort of 1 year out on why we're here, right? A year and a half out, sort of reflections on Terra Luna, Voyager, Celsius, FTX, observations sort of a year out. Khing, can I start things off with you?
Sure, I'll kick it off. So I think a couple of elements made this kind of unique in the last 1.5 years. One is everything was sort of connected, we're seeing now. And there's a couple of examples of that. 2 is a ton of leverage across the ecosystem. 3 is bad actors, ranging from bad risk management to outright fraud. And that led to a spiral, starting really with a big drop in the markets precipitated by Terra Luna, obviously 3AC folding, Voyager and Celsius having to file, FTX filing later down the line with fraud, and then ultimately Genesis filing earlier this year. So that's sort of the context of how it all got started.
Yeah, and Asher, any perspective sort of a year out from your just in terms of how we ended up here, right? Sort of the weaknesses and issues in the market that you see? Yeah,
I would echo everything you said and just add kind of the interconnectivity of all these companies and the leverage in the space. So kind of as dominoes fell, it created more pressure on the system on other companies that basically caused more companies to fall into a distressed state that ended up bringing them to insolvency or something of that nature.
Yep. And wassielawyer, I know...
Yeah, I mean, to add on to that, I think there's also the sort of like complete destruction of retail confidence in the crypto infrastructure. Because I've been saying that, if we didn't have Terra Luna and Celsius and Voyager, you probably wouldn't have seen that bank run that you saw on FTX, which obviously, made it worse and worse. So yeah, it's a combination of leverage in the system. I think people didn't really realize how interconnected everything was. And this is a product of the zero interest rate environment where everyone's printing money. I mean, we were actually in this position where, you would have people in the space say that 20% is my risk-free rate, which is slightly insane, right? Because they just stick it into Anchor. And then you went essentially overnight from 20% of the risk-free rate to, well, Bitcoin is worth 1/3 of the price it used to be.
Mm-hmm. Yeah. And so, talking a little bit about kind of the immediate fallout, right? I think probably FTX being like the cataclysmic, right? The cataclysmic event after many, many challenging events for the crypto and blockchain industry. What were you seeing in your, particular industries in your work? I mean, one thing that's great about this panel is we have folks who have really different perspectives and have been in different parts of the ecosystem. What was the immediate fallout that you were dealing with? wassielawyer, let's start with you.
Sorry, the immediate fallout from...
The immediate fallout from FTX, like what was, how did your day-to-day work? Like literally, how was it transformed?
Well, I was getting DMs on a daily basis by very pissed off people. Some of whom were asking if I was Sam Bankman-Fried's lawyer. For some reason, some people had that idea. Sam actually DM'd me sometime in January while I was out on bail. That's a story for another time. But yeah, no, I think that's kind of insane. I think the difficult part was that I think FTX came at a time when people thought the industry was recovering, because you had all this like wave of collapses where you had your Terra Luna followed by 3AC, and then Voyager and Celsius were obviously linked to that collapse. And what happened was this sort of slightly quiet period where FTX and SBF were going around saying, we're going to try and bail out the industry, we're going to try and start acquiring companies, and then all of a sudden, pretty much over the course of a weekend, the news about the balance sheet comes out, and I think it's a sort of fear, where people really didn't have any trust anymore, because I know people now sort of equate FTX with fraud, but if you look back, 2 years, when everyone thinks about FTX, they think of them as the regulatory compliant guy, they think of Sam as almost being he's the defender of crypto. I mean, sure, I think he was a bit unpopular for pushing slightly monopolistic DeFi policies in Washington, but before that, people thought of him as sort of a crusader for crypto. And then so over the course of a week or two, and a lot of my friends who are very experienced traders were sort of caught off guard, because even the FTX senior management, not all the way up to Sam's circle, but the senior guys had no idea something like this was going on. So yeah, I think it's a complete destruction of confidence overnight.
Yeah. And, specifically thinking about it in the context of bankruptcy, right? These bankruptcies and the opportunities that come out of the bankruptcies, right? Asher, you can talk to us more about your deal a little bit later on, but, sort of in the immediate aftermath, what were some of the observations that you had around the market and the opportunities to be bidding on these assets or potentially buying these assets? Asher, you want to take that?
Sure. I think in mining specifically, you have to be a low-cost producer, and so usually people raise capital and build in a bull cycle when everything's expensive, and everyone's scared to deploy large amounts of CapEx when things are cheap. And so I think on our side is having the conviction in the industry long-term to be willing to deploy capital when no one else is, and looking at opportunities to create value, not just for ourselves, but for the overall situation. And so you had mentioned Celsius, which we're spending a lot of time on to emerge those illiquid assets out of bankruptcy. And the goal is, how can we drive the most value towards that estate and create a win-win scenario as an operator? So I think we're approaching a lot of these opportunities from the perspective of, there is an asset that if liquidated would be very value destructive because there's not an inherent buyer with capital in the markets today. And so as an operator, how do we come in and drive equity value of these assets to kind of ride through the current winter that we're in today? And so whether it be in Celsius or some of the other bankruptcies we've been a part of, is how can we make sure that these assets survive and the industry continues to have a base that continues to be able to build from, rather than just liquidating anything and taking it for salvage value.
Mm-hmm. And Khing, from your perspective?
Yeah, so we're, as a fund, buyer of claims. We buy liabilities as opposed to the assets. The previous situations we looked at, Celsius, Voyager, or BlockFi, were all a bit smaller. They were called between 2, 4, or 5 billion, and very dispersed. So the claims that were up for sale were all quite small. With FTX, everything changed because it was more like a $15 billion balance sheet and very large claim holders. So in the aftermath, we started out immediately trying to figure out what was happening, obviously, on the balance sheet, trying to make some sort of assessment of recovery, which is very early and kind of difficult, and also try to buy claims. And we did both. And obviously, at that point in time, there was no claims portal. Pretty much what you were buying was a screenshot from someone, plus some KYC, plus some wallet tracing we could do. And from there, things developed a lot, actually, both to thinking on the balance sheet with more information coming out, but also on the way the claims were trading. And the other thing is, obviously, from the legal side, documentation on the assignment agreement. What do you need the document to say? Because buying a claim is literally just a contract. It's not security, it's nothing else. So love developing that.
So I think one of the really interesting aspects of all of this is that, we had, what were, in theory, very classic bankruptcy events, right, of businesses that had failed, right, but within an industry that was really new and evolving, right, and very different from any historic bankruptcy that we've seen, right? And so I think one of the challenges was that there are lots of folks who are familiar with buying distressed assets or buying equity out of bankruptcy, right, but didn't understand crypto and weren't going to touch it with a 10-foot pole, right, in the context of what was going on, right? And then likewise, we had massive liquidity crunch, right? Particularly with FTX going down, right? Where, who's actually going to be buying these assets and how is that going to work? And then I think also too, we have this highly, basically there's a sort of more of a retail base where you have many of these very, very tiny claims, right? That are out on the market as opposed to big sort of chunky claims that you might otherwise see. So I'm just curious from your all's perspective, what else is different or differentiated, right, around those bankruptcies relative to your historic experience, right, with a more traditional bankruptcy? Wassielawyer, I'll start with you.
I think there are a lot of difficult, questions relating to digital assets which haven't been properly resolved yet. I mean, it's something that you hear about all the time, right? Going, how do I value my claims? I've got a claim for 1 Bitcoin, and when FTX went down, for instance, Bitcoin was, say 17K. Now Bitcoin's rebounded a little bit. I want to claim for a lot larger amount. Why should I be have my claim liquidated at a point of time? So that's certainly one big question that's sort of relevant across all of these bankruptcies, really. Sort of seen this come up a few times now. I think another big one, which people aren't thinking about as much because we don't really want to think about it, is if we actually went and looked at the terms and conditions and pursued this English trust claim, which would really, really, really make things very difficult for the bankrupt estate. There's also the issue of taking collateral over crypto assets. I think you sort of see this in a few of these lending arrangements. How do you properly take collateral over a crypto asset? Is it like a title-based, a transfer, or do you have some sort of charge over it? And most of the time, the guys who are taking these loans in that sort of environment weren't thinking about these things. Most of them weren't lawyered up. So I just transfer you some crypto, or I would just pledge you some crypto, but what actually is your legal position? So those are some quite, I think, interesting issues, which haven't been determined conclusively or determined very well yet. And that's why I've almost always been pushing that people should just do a restructuring of some of these things, because you don't want to go to court for the next 10 years and then spend money trying to figure out, unwind all of these arrangements.
I think for the experiences that we've had, so our investor base is pretty traditional in terms of their background, PE shops, family offices, and such. And we got connected to a lot of folks in the distressed world. And when we first got connected to it, I think Celsius was one of the first large bankruptcies in our space. And there was a lot of uncomfort about even spending time on that bankruptcy. And I think FTX has changed because people have seen and gotten more comfortable with the opportunities within some of these. And you have a lot more folks kind of getting involved now. And so I think number one, to your point, when we were involved, we learned by drinking out of a fire hose and getting a lot of advice and mentorship. But there are folks who've been in the space for decades that only focus on distress, and they weren't really around because I don't think they had an underlying thesis on crypto itself and how they wanted to kind of invest in the space. So I think that's the first kind of point, because most of the debtors' plans in these Chapter 11s is how do we go and sell these assets or sell these businesses, and they go through a process and they realize no one's going to come and buy the whole thing, right? And I think that's happened throughout the course of almost all of these bankruptcies. So I think the first is who's around the table, and they have to understand kind of the distress space. They have to understand the processes in bankruptcies, because a lot of it is process-oriented and or of attrition-oriented. And then the third is kind of have a thesis on crypto and what to do with the underlying assets. So I think that's one. Obviously, in scenarios where it's just kind of liquid crypto, Bitcoin, ETH, it becomes a lot easier. The second I would say is, at least in Celsius's case, is the amount of creditors that are non-institutional and how that impacts basically the process of understanding what the creditor's appetite is for what they want to happen with the asset bases, and where there's no kind of senior lenders in the Celsius situation, the UCC is really the owner of the business, right? Post kind of bankruptcy, and what do they want? And there's this world of where I think a lot of the lawyers that are involved have been in bankruptcy forever, and it's the first time that they're actively engaged in Twitter, trying to understand the audience base and the community in Twitter. And I think everyone's kind of adapting to who is the ultimate kind of customer, and how do we make sure that we hear their needs and their desires and kind of reflect that in how we're operating kind of the bankruptcy, both from the debtor side and also the UCC side. And then there's also the nuances of the actual asset base. Taxes was a big thing, is how do we actually distribute these assets, and what is the tax impact to the actual creditor that may be receiving some of the assets that get distributed back, and would they rather have it in crypto or fiat, and the nuances of basically tax treatment in all of these scenarios. So I think there's a lot of learning that's happened through kind of these initial bankruptcies, and you have some that have gone well, others that haven't, and I think the culmination of all of this is like FTX, where you have the sophistication there now, you have a lot of the learnings of what's happened in these other bankruptcies, and you have the biggest asset base to actually create structures of kind of just liquidating, giving it back to creditors, turning them into new businesses, so on and so forth. So excited to see kind of what happens with that estate and kind of how they distribute them and maximize value through the process.
Yeah, and I think it's worth just, spending a little bit more time on sort of the retail client base, right? And because it's totally different, right, from most other bankruptcies, right? I mean, it's basically like a bank going under, right? But that does not happen typically. And so I know, Khing, that's something that you've sort of been dealing with firsthand, right, in terms of actually buying the claims, right, given that they're held by so many different individual people, and in many cases, many tiny amounts. So what's been the impact on that front for you?
Yeah, there's two ways. Definitely, the points that Ash you're making are correct, right? You suddenly go to an FTX case, a million plus creditors,
yep.
And the way the dynamics work, you then have a UCC, which represents all creditors, which is essentially without any experienced distressed investors. And a normal restructuring in Chapter 11, you have a few banks, a few hedge funds, and a few lenders. And it sort of all works out. People know how it's done. So that's all new. And I find the other thing that's interesting there is that it is often very emotional, right? People have very strong emotions versus each other, versus the sort of nemesis in these kind of situations.
I think
it's personal.
To that point, to a lot of these folks, it's their net worth, right? So many of them trusted these systems and said, it's safe for the bank, whatever it may be, and they put a lot of their net worth, in some cases the majority of it, on these platforms. So it's kind of a massive impact on their personal lives, where for an institution at the end of the day, they have a risk management portfolio, they have diversified investments, and I think that's exactly right. I mean, we spend a ton of time. I mean, our UCC is no one's institutional, and it's really understanding the impact it's had on them and the rest of the community, and how to try to do the best and try to kind of take a bad situation and try to make the mess out of it. But definitely agree with kind of the personal, emotional aspect of it. Due to kind of the assets that were put on the platforms.
Yeah, and then also conceptually you have very opposite worlds and thinkers. So crypto people are obviously very bullish to the moon, et cetera, which is part of the industry which we're all part of, which we love. And the strategy is the opposite. It's credit, it's focused on the downside, and it's sort of very conservative. So you think about if you have two creditors. One is a crypto creditor that lends or puts, say, Bitcoin on the platform. And then you have a dollar credit on the other side, right? So the moment that the company filed, Bitcoin was at, say, 17,000, 18,000, and now it's at 26. So from a perspective of the crypto creditor, well, my asset I have, it may be worth less, but it's up almost 50%. But that's not how bankruptcy works, as we know. It's dollarized at petition date. So that was very sort of a big shock to people, like, hey, but my asset is up a lot. I'm actually making back what I'm losing on the bankruptcy. No, it doesn't work that way. So that leads to very fundamental discussions in many cases. I would say the other big thing on FTX was preference risk, right? Clawback risk. So clearly there was a lot of FUD the weekend before FTX filed. About $5 billion was withdrawn from the platform. And as we all know, that's at high risk of clawbacks. And that's also a big thing people had to get used to. So yeah, all those things have play in. Fact of the matter is, when we buy claims, typically it's from larger players because it's more size. So there's more professionalism there, but you still have the different mindsets in there.
Yeah, and so I'm just curious, how do you go about differentiating, right, between, at what point in time do you decide the claim is big enough and it's worth dealing with your counterparty, and, you can more readily run all the checks on your counterparties, right? I mean, has that become more seamless, or, is there less friction now in the system? Or?
Yeah, so maybe taking a step back, right, if you think about, I've always been in the distress space, so if you think of high yield bonds that go distressed, it's a very efficient market. You got 5 big brokers, maybe another 5 to 10 smaller ones, and you can sort of, where liquidity is. There's a market, you get your Bloomberg runs. Then you go one level down, you go to claims. The big brokers don't do that, so it's more the smaller brokers, some individual sort of people that trade them, and it's either there's no market or it's very wide bid asks. And then there's crypto claims. So there was no market a year ago, and even now it's very, very patchy. So the way to do it is very much direct sourcing or direct sourcers, and a little bit through desks. And for us, the moment you have a bit of size and you sort of have done your documents right and you know how the process works, then you can go down in size. So you start small because you have to start somewhere. Then ideally you buy bigger and then you go small again because it's possible you have the infrastructure to do that. Yeah.
So Asher, so you're hard at work, right? Working on the Celsius transaction. Could you share a little about that with us?
Sure. So we looked at the Celsius bankruptcy end of last year in kind of Q4 timeframe. And at the time, as a Bitcoin miner, we said, okay, what are the Bitcoin mining assets and can we make a bid for those assets and purchase them? And at the time, kind of the debtors and the professionals said, we actually want to sell the whole company. I was like, okay, well, we don't want to buy any asset outside of mining. Mining's our core business. Probably not the right opportunity for us now. And then we kind of stayed engaged, and going into end of Q1, there was an alternative bid that came in, got a stalking horse, and the concept behind it was the company has a lot of liquid crypto assets, so how do we distribute the majority of those back to creditors? But there's also a lot of illiquid assets that were made. So there was a ton of capital put into a mining division, and the reality is if you're going to liquidate the mining assets today, you're getting $500-$600 a machine, where the equity value of like the publicly traded companies that are trading are in the thousands, right? And so there's massive kind of destruction there if you just try to fire sale and liquidate, and there might not even be the actual liquidity in those markets to actually take on that sell pressure. So I think one was there. Second, there's a big asset base and investments that were made by Celsius that are illiquid. And so the way that the current professionals have kind of segmented the assets, there's about $500 million of illiquid assets that were made, whether it be loans, investments, and such. They're valuing the mining business at about over $500 million as well. And so the idea is, how do we take this $1 billion or so of assets, and instead of going liquidate and get X cents on the dollar, how do we go and try to build equity value from that base? And so in our current plan, we went through a long bankruptcy process, brought in 4 other principals, formed a consortium called Fahrenheit. So Arrington Capital, Steve Kokinos, who's the former CEO of Algorand, Noah Jessup, who runs Proof Group, and then Ravi Kaza, more of a hedge fund background. So we found a diverse set of individuals that said, okay, how do we take this asset base and potentially go and build a kind of V2 crypto company that can have the right governance in place, the right policies in place, and kind of from day one, the shares are held by the people. It's a very decentralized shareholder base. It's all the creditors, and be able to kind of build a company the right way with the right processes. Because at the end of the day, when you look at a lot of these bankruptcies, a lot of it was driven by management as well, right? There's macro market conditions, and there's also decisions that were made by managements not that strong of a governance structure in place because it was fast-growing startup companies with a lot of capital that they were managing. So we're currently in the process of basically having creditors vote for, do they like that plan, which is we take the illiquid assets, we capitalize it with additional Ethereum, and in bankruptcy, what's really interesting, you can actually, there's an exemption called the 1145 exemption, where you can actually take a company out of bankruptcy without a registration statement. There's an exemption to that registration statement, and automatically have it be a publicly listed equity. And with the scale of that shareholder base and kind of the amount of shareholders, creditors that will become shareholders, it's not really feasible to have that as a private company post-emergence. Mm-hmm. And so currently in the process, working with the NASDAQ, but the goal is to take the company out of bankruptcy and list it on the NASDAQ as a publicly traded company with a strong kind of core in mining to start, because that's where a lot of the operational assets are today, but continue to grow as a generalized crypto company.
Yeah, super interesting. And wassielawyer, would you comment on some of these other bankruptcies and sort of where they are in the process, and what the time horizon might look like?
Well, we're not. I mean, there's a few I've been looking at in some detail. Looking at Three Arrows a lot. I've been looking at FTX a lot as well. And with Three Arrows, it's actually the more interesting one because it's quite interesting because it's meant to be quite simple. Given the fact you've got about 100 creditors in there, it's a liquidation. There's no talk of restructuring the company. But the progress on it has been actually surprisingly slow, because one thing you see with all of these bankruptcies really is this sort of mismatch in experience between the sort of crypto guys and the professionals. So the guys that understand bankruptcy generally don't understand crypto very well, right. And the guys that understand crypto don't understand bankruptcy very well. And to make things worse, they don't trust each other at all. like, sort of quickly revisiting the point about retail, you've got a lot of these UCC guys who are sort of retail investors who understand crypto, very crypto native guys. And like Khing said, their priorities are completely misaligned from the distressed debt guys. Because they come in from a crypto equity, very sort of equity driven perspective going, this is my token. I want, like, they would rather take what assets left and sort of go bet the house on, black and then sort of double it up rather than sort of think about accepting the sort of drawdown, right? So there is a lot of sort of mistrust generally. So sort of seeing this, both firsthand, also sort of on the news wires and so on, where you have got, and also on Twitter, obviously, where you've got people volunteering to help, sort of professionals trying to come in, like cryptoverse come in and be like, this is how you manage these assets. And everyone sort of, and the estate kind of thinks that the crypto guys try to lowball them. The crypto guys think that the estate and the professionals are trying to burn fees out of the estate. So I think that there is certainly a just general understanding gap and also a lack of trust across the board. So, okay, so 3AC is in liquidation, no idea how long it's going to take. A very good friend of mine advised us sort of going through the process. And yeah, it's not been easy. And then on the FTX side, I also speak to some of the stakeholders involved. Some of the members of UCC informally sort of speak with me. And the issue with FTX is, I think, exactly, there's a mismatch of expectations. There's been a lot of talk. I mean, you guys are doing Celsius, sort of building a V2 of the company. Anyone on Twitter space knows that everyone keeps saying, I want to do FTX 2.0, you want to reboot FTX. But that's just a very big idea. How do you actually do it? How do you actually slice the economics? There's not going to be someone that comes in and does the whole thing for you for free and gives you all of the upside. Someone's going to have to come in, someone's going to have to run the company, someone's going to have to put in the governance that wasn't there before. And that's something that people don't quite get all of the time. But even then, on the other end, some of the institutional guys also don't really understand what makes these retail guys tick. That's why any sort of talk of any sort of token, any sort of upside recovery, it's actually way more attractive to them than saying, I'll give you 60 cents on a dollar. Because when you start offering them, for instance, 35, 40 cents on a dollar, they're going to say, why are you offering me 35, 40 cents on a dollar? Are you trying to cheat me of my claim? What are you trying to get out of this? So it's a difficult scenario. I think FTX is going to take a little while more, given how the estate is put together. I think 3AC is going to take quite a long time because of all the various litigation claims and how, incestuous everything is, where you've got all these big lenders, lending to 3AC, being creditors, but also having preference claims against, clawbacks against them. So yeah, I mean, I can't commit to time, but probably a couple of years unless they work something out.
Yeah, and just picking up on a comment that you made just now, right, in terms of how incestuous and how insular, right, the industry was, which really was a terrible factor, right, and really was part of the cause of the whole domino effect. As people are looking to rebuild within the industry, right, are you seeing sort of lessons learned on that side, right, where people are rebuilding in a more diversified kind of a way? I mean, I think, anyway.
I can get off. Yeah, one thing is interesting. Obviously, the whole thing about blockchain crypto is that it's trustless, but these things all show that there was a huge amount of trust with massive exposures to one another, because FTX is never going to fail, or 3AC is never going to fail, or Gen's never going to, and clear that all fell apart. And I think, as you say, the industry needs to rebuild. Ultimately, a lot of this lending was clear, it was under collateralized, or sometimes even without any collateral. Counterparty risk, collateral, it doesn't have to be over collateralized like in DeFi, but surely different collaterals, actual margin calls. I think that's changing. A more diversified base for sure, and hopefully, as was also pointed to, best practices and checks and balances in place, right? Corporate governance, et cetera. Won't go into the talk of regulation on this panel, but it's obviously another thing that may have some impact. So I think overall, in that sense, we're actually very positive about the industry. This is a painful episode in that sense, but also it washes out some of the bad actors, it cleans up bad practices. It also gives new capital to the industry of things changing hands, and we can hopefully move forward from that.
Asher?
Yeah, and I would say I agree with that wholeheartedly. And I think the amazing thing about crypto and DeFi are the new technologies and applications that have been built. But at the end of the day, I think if there are people still making decisions and running it, strong corporate governance and checks and balances are critical. And I think if you look at 2021, I mean, I'll call it FOMO, but there was so much basically excitement on the industry of this is revolutionary, this is going to change. And a lot of traditional investors kind of ignored all the lessons they've learned through the financial markets over the course of history. And I think now you're going to see a world, and Celsius, they just announced the board, but you're going to see a world where you want to keep on driving innovation, keep on driving growth, but at the same time, take lessons of learned not just in crypto, but throughout kind of history of the financial markets and apply those checks and balances, apply those knowledge. So on the Celsius board, there's a lot of folks in their background is more in the traditional finance world, in the stress world, and bringing that governance in as well. Meanwhile, having kind of the executives that want to drive growth and love the sector and believe in longevity of the sector, and basically finding the harmony between old and new.
Yeah, I think sort of just to add on to that, right? It certainly is the case that I think it's very easy to sit here in hindsight and say, look, everyone in 2021 was mentally ill, or probably are. But the fact is that back then, if you wanted to spend some time doing due diligence on anything whatsoever, there's no deal, right?
Yeah.
So you either transfer 50, 100,000 or even $1 million US coins into this random wallet address, or I'm going to get the next guy who's going to send it to me. And that next guy is going to make a 5x on his investment in the next month, and you're going to be sitting there being poor. So that's kind of the landscape that 2021, 2022 was. And if anyone sort of said anything about governance, and there were people who were saying stuff about Luna and Terra and their governance and whether or not it actually worked, and you just get shouted down because you had too many retail investors in it, and they're all betting their lives and their life savings on it. And then obviously when everything collapses, then all these retail investors now become very, very upset retail participants they have to deal with in sort of any sort of bankruptcy scenario. Mm-hmm. So going forward, I mean, currently in the sort of macro environment we're in, where capital isn't cheap anymore, you certainly will be seeing a lot more people, certainly there's going to be due diligence done now. People are going to care that you actually have things properly set up before just transferring coins into a wallet address. But the crypto guys will always want to find the, fastest growing protocol, right? And most of the time, the fastest growing project is one with very loose corporate governance. And people almost like rallying around one or two of those people. And if you look at the last cycle as a sort of example, I actually once asked a friend, I said, one of the smartest guys I know, I said, how does Luna and Terra work? He told me it doesn't. I was like, why do people use it? Oh, because they think Three Arrows is going to backstop it. Are you going to bet against Three Arrows? Mm-hmm. And now a lot of people sort of like mock the founders of Three Arrows. The fact is in 2021, 2022, everyone was lining up to get money from them. They were seen as these guys that couldn't fail. Everything they touched turned to gold. So in hindsight, you look at it and you go, oh, Voyager maybe shouldn't have so much of the loan book, was around 40% of the loan book to Three Arrows. But back then, it looked sane. This was probably the safest loan on their balance sheet, if you went back 2 years.
Yeah. All right, great. Well, we have just 1 minute left. I think just as a wrap up, I guess, looking ahead, what is the next distressed opportunity? I don't know.
To be honest, it seems in terms of all those interconnectivity, that seems to have run its course, mm-hmm. hopefully for the industry. Mm-hmm. And you never know about idiosyncratic events, right? But I think whenever there's FUD around, which there's from time to time, it seems to subside these days. So it's also a bit more stability in the industry, which is good, I think, in general.
Yeah. Uh-huh.
I think from our side, on mining specifically, going to the halving, there will be more times as well to kind of go through it. And I think on our side, it's how do we just continue to kind of roll up our sleeves and more put in sweat equity to kind of build value. And I think these periods of times are the best time to build and not when there's so much hype in the markets and everyone's trying to build at the same time. So I think for people who believe in the industry, start building now and start building if you have the long-term conviction in whatever project or sector you're working on in the industry.
Yeah, I think that's absolutely right. I think this is the right time to build. I do know there are some founders that get a bit discouraged because a lot of these founders are very young and they get used to, they got in crypto in 2020 and I just raised $8 million of a pitch deck that I put together in 24 hours. And now you try to go to the market and raise any money, you're not raising that amount of money anymore, not a sort of valuation anymore. I think there's still a lot of zombie companies sort of going around. they aren't the size of those that have collapsed. Maybe the sort of venture-backed startups that have raised 10, 20, 30 million dollars in the bull market, and they've never found product market fit. So they're just sort of slowly, zombie companies sort of burning through the treasuries, issuing tokens, doing all sorts of strange shit. So I don't know if that's a distressed opportunity specifically. And actually, I've seen one like this. Sorry, I think I'm running over time, but I've seen a few like this where you've got zombie companies and you've got an opportunity for funds with strong operational teams come in, take over their treasury, and build something good with those funds, rather than having a 19-year-old with no experience pay himself $200,000 a month. Yeah.
I think that's a great note to end on. So thanks.
Yeah.
All right.
It's a great opportunity, Khing. You should look into it.
Yeah.